All right, here we go. Hi, welcome to this episode of the Uncommon Wealth Podcast. I'm John McDonough, JMac. If you're a business owner or part of a high net worth family, chances are you've been told at some point that a life insurance strategy is best in class. But here's the real question most people never ask. Best according to what assumptions? And more importantly, what happens when those assumptions don't hold or don't perform? One of the biggest issues I see in the insurance space is that most designs are built to look good on paper in year one, not to perform under pressure in years 5, 10, or 20. And that's why today's conversation is different. Today, I'm joined by Seth and Eric from 3 Points Insurance Design. They don't sell insurance, they don't represent carriers, and they don't get paid based on what product is chosen. Their role is simple but critical. They independently analyze, audit, and stress test insurance designs so decisions are made with clarity, not hope. I use firms like 3 Points because when we're talking about 7 and 8 figure balance sheet decisions, good intentions aren't good enough, right? The conversation is for business owners, founders, and families who want to understand how insurance should actually be evaluated, not marketed. Seth, Eric, welcome to the Uncommon Wealth Podcast.
Thanks for having us.
Loving us, John.
Awesome, guys. Let me start here. From your vantage point, why do so many insurance designs look great up front, but underperform or break down over time?
Yeah, that's a great question. I think that's a perfect place to start. Ultimately, there's a failure from a educational standpoint that most advisors miss, and that's how and why a product was developed and to be the most efficient for future use. So when we talk about like in the crux, like designing a policy for a particular client, there's so many levers in any type of product, like index universal life, variable universal life, and even whole life, that can move up, down, left, right. And without modeling and stress testing and understanding why that would happen, you're only creating a situation of an unexpected reality of the swings. No different than the stock market. I mean, no mutual fund will ever show, a projection of, let's say, 6.5% linear all years every year, because that just is unrealistic. It's not going to happen. Well, no different in the insurance world. When you're building a policy for long-term sustainability, our practice as an advanced case design firm is to underpromise, overdeliver. Not only are those levers easy to manipulate based on what could happen, but the mechanics internally of a policy needs to be understood, meaning the expenses, why the expenses would change over time. And whole life, they're going to be guaranteed. They don't move, but that dividend rate will move. And so what does that mean to the policy, and how would that policy react to that? In a UL, a current assumption UL, those are based on fixed rates. Like when a company raises, lowers, what does that do to the policy? And more specifically, how do the internal expenses play a role in those rates changing? Same with index. Like if an index bucket earns X this year and Y next year, and those COIs continue to change year over year over year, like early in an index policy or really any UL policy, there's always higher levels of expenses because of the premium loads. And over time they come down, but over time the COIs are increasing. So, that's why it's best in the early years to build a policy that's, especially for accumulation purposes, overfunded to overcome any future rate changes and fluctuations in the rate that could potentially penetrate the cash value and put that policy in jeopardy of lapsing. Eric, anything you want to add?
I mean, Seth, one of the things you hit on is kind of that static input. We know we don't live in a static life. You don't get, a 4% return, a 6% return every single year as most illustrations will typically show. An illustration is usually just going to show a best case scenario or best case assumption. And it really just kind of provides, short-term performance optics. Designs, a lot of designs that we see, quite honestly, they're built to illustrate well, but the question is, do they actually hold up over the long term? You're buying a life insurance policy. It's supposed to last for someone's entire life. So you need to really make sure that, when you're designing something, you're not just looking at the short term. You need to take into consideration, what could happen 5, 10, 15, 20 years down the line. Because illustrations, they typically assume that the future is going to behave politely, just to be frank. Real life doesn't always behave that way. So that's kind of, what we typically try to do when we stress test and when we run things. We're not just running it at an AG49 rate. We're not just, looking at it from one angle. We're looking at it from a number of different angles, and we're trying to come up with, a number of different ways to make sure that something, you could never say it's foolproof because we don't have a crystal ball. We don't know what's going to happen in the future, but we try to cover as many angles as we possibly can.
And when you're reviewing a design for the first time, you've already talked about it a little bit, what are some of the assumptions you immediately look at that tend to create the most long-term risk?
Yeah, good question. So it's interesting. I saw this question, but I had a call from a buddy of mine last night, and he's in the business. He has a firm with Edward Jones out on the West Coast. So he just called me and he's like, "Look, I don't know. I don't do a lot of insurance. Let me just, can you help me understand what's going on here?" And it was nothing more than a run-of-the-mill illustration. There was no real design strategy for the particular case that he was trying to accomplish. It was a survivorship case, and I'm not going to tell you the carrier, but everything was general. It was a VUL, ran it, weighted averages. It wasn't allocated properly. They didn't run the premium correctly. It was a pie in the sky, 6.5% gross rate of return. It was nothing. They didn't really dive in to understand the case. He asked for an illustration. He gave them a lot of information about the client, what they were trying to accomplish. It wasn't a huge case. It was $1 million second to die, but it's still a good case for him because, he's more of a wealth manager. So, he called me last night and he sent me the illustration. We went through it together and I was like, look, at the end of the day, this is nothing more than an internal sales role person. I don't know how to say it, like a sales support role that doesn't really take a lot of time to understand these products. They probably ran, all the market at the same rate at 6.5%. They assumed a weighted average. They didn't really dive into understanding the mechanics of the case and what it really needed. So I was like, look, if you wanted to redesign this case, this is what I would do. And I kind of walked them through. I was like, there's certain sub-accounts that we've done our due diligence on inside this particular product, this survivorship VUL. And I understand those sub-accounts. I was like, I know, with insurance, you want a low expense ratio. You're trying to set it up for future fluctuations in the market, but also you want to have a secondary guarantee, and that product can have one. And because of the way it was ran, it missed the mark of that secondary guarantee, which could max out at age 90. And they were short at age 81. I'm like, that's 9 years. I'm like, and that 9 years of funding is probably a difference of $200 to $300 a year, which is well worth it and would not do anything to really affect the IRRs on the case, internal rate of return on the case. So I kind of walked him through. He went back. He actually just emailed me about an hour ago and was like, hey, I requested it. You're right. It looks just as good, if not better, based on what you told me to do and request. I was like, exactly. These cases, when you're working on a case like that, understanding not just, okay, well, what if I change the rate and how does that affect it? But, what are the COIs if I change the no lapse guarantee period? What happens if I change the gross rate of return to a lower number and allocate to a lower expense ratio sub account? I mean, all of these levers can maneuver a policy for more efficiency and help the client feel much better and have a greater sense of peace of mind. You know what I mean? Like,
Yeah, that's
I
also
don't
the
know.
challenge.
What's that? Go ahead.
I was going to say that's also the challenge when you have someone who doesn't, admittedly isn't full time into the life insurance space, sending an illustration request to an internal at the carrier, and that person, to no fault of their own, because they're not properly trained as well, they're spending, what, 2 or 3 minutes to run the illustration, just sending it right back to the agent and then saying, is this good? Is
Yeah.
this good? Do you want this? Like, they don't know, right? They
Yeah.
don't know what they don't know.
Yeah, 100%. I mean, one of the things that we do as a third-party carrier-agnostic case design firm, and that's all we do. First off, we never look at target premium. And I know advisors, that's how they get paid. We understand that, right? But because we don't look at that, because we don't look at the carriers for a carrier, but more of a product manufacturers, like, okay, well, no different than going to Best Buy. Like, they have, how many different TVs are available that you could buy from, whatever, Samsung and this one and that one and whatever. Well, there's a reason why there's many different TV manufacturers. It's like there's not one that fits each individual's needs. Well, it's the same thing in the insurance world. There's so many different carriers and so many different products. Understanding where each one fits will help overcome the inefficiency of just running run-of-the-mill illustrations and splashing it over to an advisor to show their client and hope that's the correct fit. And so diving in deep, and like I was saying, our understanding of all the sub accounts that are available in different VULs and the index buckets and index accounts, and the historical rates of fixed UL products help us with a clear vision and design strategy for each individual client so that we can make the most efficient policy that not only is good today, but will stand the test of time 10, 15, 20, 30 years from now when you need that policy the most. And that's at the time of claim. I mean, it's just, that's what it is what it is. Like, you need that policy there when you're going to submit that claim. And if anything goes sideways, that's just setting you up for failure. And it's better to underpromise and over deliver than anything else, right?
And
Eric, anything?
Sorry.
Seth and I both work for carriers. So, and I'm not going to pick on carriers because you're right, John. It's at no fault of their own. They're dependent upon, what they may have been trained on or what they know that's specific to their product line. When you call a carrier for an illustration, that carrier, most of the time, they don't know about the other carriers' specifics in their product lines. So they're going to give you the information based off of what they know on their specific product.
Yeah.
Having worked, for a carrier for almost, for over 17 years, kind of in that role, we have to remember two things. Number one, they are salespeople as well. So they're always going to try to make their product look as good as they can. Which typically means there's not going to be much stress testing that's going to be done when you go to a carrier. Right. Even if you ask for it, most of the time they may give you a little stress here or there, but they're not going to really run it through what we would run it through because they want that sale. So their designs, they're typically not optimized for longevity. They're optimized to be sold. I heard this a long time ago. It's something that stuck with me. So I used to work for a small general agency here in Colorado, and it was actually my uncle. He mentioned this to me. Again, it's something that just has always stuck with me. He told me most policies, they don't fail suddenly. They bleed out slowly. By the time anyone notices, the options to do anything about it are gone essentially at that point. So that's what we want to try to avoid when we design cases at 3 points. That's why we are, we pride ourselves on making sure we know, as Seth mentioned, we know those index buckets, we know those variable accounts, and we really try to make sure that we are fitting every case that we do design work on. It's fitting those exact customer needs, because every case is going to be different. And when you call a carrier, they're going to treat you as Seth said, they're just kind of splashing everything out there. You're going to get treated just like the other guy that called in, the 10th guy that called in before you. There's not much difference.
And that's good to catch those on new issue designs and new issue policies. But a lot of people listening to this podcast already own policies. When someone brings you a design they've been shown or that's already been implemented, what are the most common red flags that tell you it hasn't been properly vetted?
Yeah, well, there's quite a few. I mean, I would say the first one is like if a client was shown a single illustration or one single scenario, I think that's a very big red flag. When Eric and I look at a case, we look at the entire market every single time. And we have access to everything you can think of in the entire industry. So, it's kind of interesting. We always talk when we talk to firms and what run through cases, everybody asks, well, why do you take the time to understand and look at everything? It's because we need to do our due diligence so you don't have to. Like, we spend that time. That's what we do, is we don't want our advisors to waste that time. We want them to make sure they understand the client's needs, the goals, the wants, and the concept that fits them the best, and let us find the right, product. It's that, like, going back to like that whole thing about walking into Best Buy. It's like, I don't know what TV I want. Hopefully that Best Buy person's like, well, what are you looking for in a TV? What do you do? Do you stream? Do you have, regular cable? Like, what do you play games? Like, what do you do on your TV? Well, if I tell him, like, well, this is what I do, X, Y, and Z, and he's like, well, Samsung wouldn't be the right one for you, and this is why. And, we've already done our due diligence. Well, it's the same thing with us, right? I mean, if you, John, bring us a case and say that, this is the client's goals from the jump, we're going to run the entire market. So one of the common red flags we see by a lot of firms is they'll just run one carrier, one illustration, and send it off and say, well, this is the best, and then, most advisors would be like, well, great, thanks, I appreciate you getting it to me. But then, quite frankly, the other red flag in that same scenario is the advisor not asking, why is this the best? Like, What did you do to make sure this was set up to be the best solution? Sometimes I know advisors, they're very busy and they, go through, meet with their clients on a regular basis. And so they're like, all right, great. Well, they're trusting that the sales support person, either at the carrier or even at a BGA IMO, brokerage general agency or independent marketing organization, understands the case and will send them the best thing. But here's the story. Advisors who sit across the kitchen table and either review an existing policy from a client or are looking at a client and helping them with the right solution off the bat, that they don't have insurance or they need more insurance. Well, a sales support role person at a carrier or at a BGA or IMO, they do not sit there with them. They don't know what that conversation is like. And so when we, as an advanced case design firm, Eric and I, we ask the questions because both of us were in the field. We both sold. We understand it. We know the products. And so understanding what that conversation was all about will help us overcome that red flag that we see. That's personally what we do. The other red flag that we see quite a bit is that there's really no downside or alternate rate projections, right? They'll just run like an IUL at AG 49 and be like, well, this one had the, like let's say they're looking for the lowest premium for $1 million all the way to Endow, which is generally like age 121 or 125. They'll just say, okay, well, this product XYZ carrier had the lowest premium at AG 49. Here you go. And they'll send that single illustration and be like, this was the best. They go, well, why? Did you stress test it? Did you show, 50 basis points, 75, 100 basis points drop from the AG49 rate and then throw 0% every 5th, 6th, or 7th year, how does it stand up then? And what index bucket did you allocate to? Did you just do a benchmarking to a 1-year S&P 500? Or are you using volatility controlled indexes? What did you do? How did you show this to be sustainable? And I think that's a huge red flag that unfortunately we see all too often. We see it regularly. A lot of our firms will bring us illustrations from their clients that they're being shown extremely hypothetical pie in the sky numbers that we know is just not going to be linear all years, every year. And unfortunately is probably going to be set up for failure. Eric, you want to add?
One of the things that I think we see far too often is between the client themselves and the advisor, the goals aren't always clearly communicated. We see it so many times where we'll get an initial request and it'll be an accumulation play. And then they'll come back and say, well, turns out they actually just want protection, or vice versa. The clarity around what the customer wants has to be of the utmost importance. It's got to be clear what they're trying to accomplish. What are they purchasing this policy for? I think that's one of the red flags that we see pretty frequently is, when we ask our due diligence questions to the advisors, if we start to hear a lot of, I don't know, or, just do it this way because this is how I always do it. When we get those types of responses to us internally, that's a little bit of a red flag to say, hey, odds are we're probably going to have to work on this case a couple of times because I'm guessing they're not going to get it right the first time. It can be minimized just by asking simple questions by advisors. We try to help the firms that we work with. We try to help provide those types of questions to say, hey, maybe they don't know what they need to ask. So we try to help them with that. But, ultimately, I think, when we start to see people who, get wishy-washy or don't really come with clarity around, what is being requested or asked for, to me, that's the biggest red flag. When you have an agent who has their heart set on a specific carrier, why are they set on that specific carrier? Is it because they pay the highest comp? We try to, dig deeper to make sure that we are exploring every option. The other thing is, this goes back to advisors. When the advisor can't clearly explain to us the product, or, they don't always have to be product experts, but if I'm asking questions around, well, do you want to show a full pay? Do you want to do a 10 pay, a 20 pay it to 100? And they don't know the answers to those types of questions, and they want to see 7 different options. That's a pretty big red flag to us to say, hey, we really need to be more laser focused on what we're looking for, because our job as a case designer, there's a big difference between somebody who just runs illustrations and somebody who does case design. Our job as a case designer is not to sit here and provide you with 10 different, illustrations on the same run. We want to make sure that what we're showing you is something that you can present to your customer and have confidence that this is going to be something that can withstand the test of time. Those are some of the red flags that I think, we come across pretty frequently.
Yes. So it appears, everybody, that we've lost John here, unfortunately. So I think Eric and I will just continue and take over, and John will join back when he's able to get back into a better Wi-Fi zone. So I guess what I would jump into next is, the listeners out there, there's definitely questions that I would encourage you to be asking your advisor when it comes to your policy or the insurance that you're looking for. And, as we talked about in the past, one of the things is, what are these assumptions and the design needed to require for the policy to survive. There's John. He jumped back in, but we'll continue. And then, you're back. Okay, we were just talking about, I was just telling the listeners of like some questions that they should ask their advisors, like when they get a design. And one is, what are the assumptions that the design requires to survive? So, if you're looking at a policy and it's like ran at AG49 linear all years, every year, that's okay as long as there's a no lapse guarantee, right? So if there's a no lapse guarantee that runs to 100, 105, 110, 120, and even under a 0% max charges scenario, it still survives, well, I would say, okay, fine. But if you're looking at something, more current assumption driven without a no lapse guarantee, then you need to find out, like, all right, well, what if the AG49 rate is 6.33, but it earns 5.33 or 4.83 or 4.45? Like, will it survive? What will it need to survive? Like, how, if that happens and I average that over 20 years, will I be required to add more premium? Because that happens. And unfortunately, it's flawed designs from the jump, right out the bat, that the assumptions are assuming that this policy will perform at a certain rate, linear all years, every year, and this is the premium that will drive it. Well, if the rate is lower, that can only mean one thing, that potentially more premiums are going to be needed down the road. So, and that's another question that goes hand in hand there, is like, what happens if the return is lower for longer? Well, then, like, what does that look like? So instead of a, let's say, AG49 rate of 6.33, what if it averages 4.33 over the first 20 years? Like, what does that look like? Like, does the cash run out? Does it lapse? Do I need to put in more premium? So, these are all things you're going to need to know. Eric, anything else you want to add?
Well, we work with a lot of firms that have business policies for business owners. For those individuals, it might be important that you need to ask about an exit plan. What does the strategy look like if we have to unwind this policy? How do I, what are the tax consequences? What does that look like? I know not every advisor is going to be able to answer all of those questions, but what we try to do, John, is we try to make sure that we surround ourselves, because look, Seth and I don't know the answers to everything. We try to surround ourselves with a group of experts that if we don't know the answer to something, we at least know where to go to get the answer to that question. So a good advisor is going to be able to do the same thing, right? They're going to, if they don't know the answer, they're going to have a CPA they can turn to, or they can have, a tax attorney that they might be able to, or an estate planning attorney that they might be able to turn to. It's really surrounding yourself with the right people to make sure that just because you don't know the answer, you can still find the answer. But, Seth, I think you covered a lot of them. They all kind of merge and meld into one, underlying thing, though, is ultimately, if you have an advisor that can't give you clear answers, they probably don't know the actual design. They're just selling you something. That's, for us, what we try. Obviously, we're a third-party firm that works with these advisors to help them build the design. Ultimately, though, we want that advisor to feel like this is something that they designed. We're working kneecap to kneecap with that advisor. We're not just feeding them something to say, go sell this. John, you talked about it earlier. We don't sell. All we do is we essentially take information and run it back, run it through what we decide that we feel is kind of the best solution. Ultimately, though, the advisor is the one who has the say in the matter to say, yes, I'm going to present this to the customer because I feel like this is the right solution, or not. And so I think, making sure you're working with an advisor that listens and is able to answer questions It doesn't always have to be immediately, but able to get you answers to the questions that you have around your policy and around the design around it is of extreme importance.
So we lost John again. Just FYI. I guess we'll go to the next topic, which is, I guess, the optimized myth. And what does optimized mean, and what does an optimized policy miss? Right.
So
go ahead, Harry.
I'll talk a little bit about this. I mean, so to us, right, optimized, what it typically means, and I'm not saying that this is what we feel. I'm saying that this is what typically we think agents or advisors kind of interpret as optimized. Things like lowest premium, highest illustrated cash value. What illustration shows me the cleanest chart, so to say. You got to remember though, optimizing for illustrations is usually going to be the opposite of what optimizing in real life actually means. Optimizing typically ignores things like volatility. It ignores behavioral risk. We know, one of the most common reasons for a life insurance policy to lapse is because a premium wasn't paid. Sounds basic. It's a life insurance policy. You know you're gonna have to pay your premiums, but because we deal with cash value policies, a lot of times there is the ability to skip a premium. In most cases, though, an illustration isn't taking into consideration that you're going to skip a premium. Things like long-term capital efficiency, liquidity timing, those are really kind of things that we feel sometimes are ignored when we talk about optimized. What does that policy look like on back-to-back 0% years? What does it look like if we have a stretch of 8 years where we don't hit the cap? So stress testing, those are the kinds of things when we talk about what an optimized policy looks like, we try to make sure that we're able to show our customers. Seth, anything you want to add?
Yeah, so I think that it's also important for advisors to understand from an optimized scenario standpoint, like what happens if those assumptions don't hold. We kind of talked about it earlier, but what does it mean like for the policy? And reality starts to set in, and a lot of those situations for a client is cash values will lag or be lower than expected. Any loans that are taken from a policy will compound faster than expected. So for example, we work on a ton of loan rescues, what's called a loan rescue. And we see a lot of that, especially with whole life, participating dividend paying whole life policies where loan rates are extremely high, upwards of 6%. And the dividend, is less than or equal to roughly around the same loan rate. So your arbitrage turns out to be extremely low and or negative while you have a very high cost of insurance inside of those policies. No different than a UL or an IUL or VUL. If you have a loan, it's like, what are the loan rates? What does it do to the policy? What are those charges? How does the loan plus the charges plus the fact that I'm not paying premiums do? And all of those could make the policy collapse. Like, would I need to start my premiums again? So these are all assumptions that need to be revisited when they don't hold up, when the initial run isn't what it was expected. We do a ton of policy review work and look at policies that have been in force for 10, 15, 20 years already. Especially, we do a ton of work on old whole life policies where interest rates on loans are about 8% and the dividends now have come down drastically over the last 10, 15 years, and they're now sitting at like 6%. Well, those policies are ripe to fail, right when you need them the most, because 20 years is 20 years later. So anyway, John.
Seth, would you say
said,
that it's fair to say that policies don't fail strictly because of market changes? I mean, I know we've done some marketing around, the old zero is your hero, let zero be your hero type of thing, but I think that is something that I'm specifically talking about IUL. Um, Market changes don't typically, they're not the sole factor that
correct.
when it comes to reasons why policies fail.
100%. Yeah, agreed. Yeah, it designs because it fails because the initial design was not set up correctly to sustain those severe fluctuations in policy. So, we did put out a marketing piece recently showing that, in an index universal life, all things being equal, if you have 0% straight, which we all hope would never happen, for 20 years, how do you overcome that? Well, you overcome it by setting up the policy initially to overcome that 20 years 0% stretch. And that's funding it correctly, having those assumptions right off the bat so and then the policy will perform. I mean, we did a toll test showing that 0% for 20 years in an index universal life, what would happen if I fund it appropriately? Well, it actually sustained and didn't lapse until, this is on a 55-year-old male, until they were 91 years old. That's 36 years straight that policy continued to stay in force, funded correctly with 0% all years, every year. So now that is a very unlikely scenario, worst case scenario, which if we get 0% all years, every year for 36 years straight, we're all in trouble. But, that's ultimately where, the market doesn't create the failure, it's the design. Because, if we were to run it at a regular, solve for premium, it would have failed much faster. So, yeah, absolutely.
Yeah.
So I was just saying, sorry, Eric, John is having internet issues. He said he'll be on in a minute. So I guess we'll keep going.
Yeah, we'll keep going. So I know the next topic he had sent over was around independence and conflicts. And, we wanted to talk a little bit about why being carrier agnostic. I know we talked about that up front, but why being carrier agnostic changes everything. Seth, do you want to talk a little bit about kind of our approach and how being carrier agnostic really gives what we feel is kind of the best look for everybody?
Yeah, 100%. I think it's crucial. I think advisors should be that way. I mean, the fact is that we don't have an incentive, meaning we're not getting paid a commission to sell a particular product or a particular carrier. What we do is, because we're carrier agnostic, we are looking for the correct solution for every client. I mean, there's no client that is exactly the same with the exact same scenario. It just doesn't happen. I mean, there's all the assumptions that come into play. For example, the name, the age, the date of birth, the health rating, what the face amount is, what their time horizon is, what their risk tolerance is. I mean, it's very wide ranging from client to client. So because we know that there are so many carriers and so many products, they would, if it was a one carrier, one product solution for every client, then we really would have one carrier and one product, and that would be it. So understanding, and that's where that carrier agnostic mentality comes into play, is understanding and searching the market for the best solution, gives us the incentive to find what fits that client best, not just a force fit of a product or a specific carrier. And it gives us the freedom to compare everything honestly. Like, okay, well, all things being equal, if this is the client, we run everybody the same, and then we run everybody in a stress test environment, which one is going to hold based on what the client is trying to accomplish? Which one won't? Well, then we can remove those and find the right solution. And ultimately, I think the biggest thing is, from an advisor standpoint, they move from a role of being a product seller to a risk manager. And if you are a risk manager, because you're working with like a third-party case designer like us who's carrier agnostic, then you're really putting the best interest of the client at the forefront of every single case. And ultimately, the second role that shifts is like not being a product advocate. For example, like we like selling XYZ carrier because they have, ABC product. They become more of a design skeptic. Like, well, why does your product work? Why should I use your product? What does the best client for your product look like? And how do I design it so that it's the most efficient that stands the test of time? So ultimately, very simply put, when you remove compensation from the equation or commission, you have the ability to be very clear, to use clarity, and to be focused on that individual client's needs. So that's where I think carrier agnostic changes everything.
Yep. Yeah, I agree 100%. I think it's one of the pillars that we've, built 3 points on is being carrier agnostic. You nailed it. When you remove compensation from the equation, it gets clear really fast on which carrier provides the best outlook. Moving on, the next topic, what changes when durability is the only objective? I'll talk a little bit about this, but when durability is the only objective, the conversation typically shifts to, safety, the margin of safety, in flexibility over precision, making sure that, I talked about it a little earlier, making sure that you're kind of laser focused on what the objective is possible. You want to make sure, obviously there's a lot of different products out there. When you come to a third party, case design firm, we're going to look at the entire market when we get something presented in front of us. It doesn't matter. We do that every single time. We look at all the carriers out there, and trust me, we have access to everything under the sun. We look at every potential outcome to make sure what we're putting in front of the customer is going to, survive over the next 20, 30, 40 years, however long that, lifespan might be. We want to make sure what we're presenting is what survives, not what sucks. I think, Seth, we know just from past experience, not every advisor takes that same approach. So when you talked earlier about, making sure we're trying to educate as well as doing our job, I think that's a big thing that we try to do is we try to educate, hey, just because carrier X pays out, a higher commission, you might want to look at this product because this actually performs better for the customer. So I think education is another big piece of that puzzle.
Yeah, agreed. Absolutely, 100%. I think, when we put a case together, because a lot of times we're surveying the entire market, it may very well be and likely that the advisor may not have even seen or heard of that particular product or carrier in that particular solution that they were looking for that client. So we usually put summaries together in analytics so that the advisor could sit there and have a very high-level education conversation with their client, why we came up with it and what we found for their particular scenario is the best, right? I mean, not from an illustration standpoint or a number or a pie-in-the-sky hypothetical, but why it was the best, that it would be a solution for them over the next 20, 30, 40 years from now. Like, this is going to stand the test of time. Now, all of that being said, and we've said it a few times, like, okay, it's going to stand the test of time 20, 30 years from now, 40 years from now. But the advisor still has a really important role, and that's to do annual reviews at a minimum with their clients. I just want to make sure that's being stated out there for anybody that's listening. If your advisor is not meeting with you at least once a year and reviewing your insurance portfolio, I think it's time to find a new insurance advisor. It is crucial because, as history and statistics have shown, something changes in an individual's life usually every 6 months, whether that be having a baby, getting married, buying a house, having a kid go to college, or starting a business, selling a business, whatever the case may be. Every 6 months, something changes. So maybe you get a raise, right? Or a promotion. I mean, that money could go to work for you. And if your advisor isn't meeting with you and talking through those scenarios and revamping your portfolio accordingly, like I said, I think you need to find a new advisor.
Yeah, I agree, Seth. The annual policy review was something that was hammered home to me back when I first got into the business 25 years ago. It is, if you, like you said, if you have an advisor that is not doing an annual policy review for you, it's time to find a new advisor. They are critical to making sure that your policy continues to perform and ultimately lets you achieve the goals that you originally set out for. Seth, you listed out a number of things that could change. What about somebody whose health may have changed, who might need to go out and buy more insurance? Well, if the health has changed, what are the options? Or even something I talked a little bit about earlier, an exit strategy. Maybe you no longer need that insurance. Sometimes insurance comes with a pretty hefty bill. If somebody doesn't want to continue to pay that premium, but you might have a boatload of cash built up in that policy, you don't just want to surrender it if there are other options. So making sure you know what all of your options are is extremely important.
Yeah.
Seth, I'm going to switch gears a little bit. I know I'm kind of playing host here, but I'm going to talk. I'm going to let you talk actually a little bit about the next topic, because I know it's something that you worked a lot with over your career, and that's premium finance and leverage. So premium finance, it can have, it can go both ways, right? There's been a lot of good that's been said about premium finance. We've seen some really nice victories with premium finance cases, but they also can go sideways pretty quickly. So what, kind of talk to us a little bit about the lay of the land with premium financing today, and then, what type of extra scrutiny do you think needs to be put out there when somebody's looking at doing a premium finance case?
Yeah, totally. This is a big topic nowadays in the industry, and I will tell you that when it comes to premium financing, there's a phrase that I like to use, and that's leverage magnifies discipline, or it will magnify mistakes. And because you're leveraging out and using a premium financing strategy, it is crucial for anybody who's designing it, A, or B, the advisor and the client and anybody that's a part of this equation of recommending premium finance, to slow down. Make sure they really take it in what is happening and examine every little nook and cranny about the policy, the exit strategy, the loan terms, what is the liquidity of the client, what would be my collateral, how long is the rate lock for the interest. I mean, everything now is more important to scrutinize than just a regular non-finance policy, because there's so many levers that are going to get pulled. One of the biggest things that we work on, because when we do a premium finance case, we really are very, very conservative, especially today when you look at the interest rates that banks are offering, which is generally, SOFR plus a spread, somewhere in the 5.5% to 6% range is what is the arbitrage. And what I mean by arbitrage is if you have a loan rate of 5.5%, 6%, and your interest crediting rate in the policy is 6%, you could have a negative, or even worse, a very flat arbitrage. And ultimately that means one of two things needs to happen. Either A, the client needs to pay some sort of premium to offset the accrual of the interest, or B, they should pay a minimum of the interest of that loan every single year. Otherwise, the policy will not be able to perform effectively, and there won't be a very clear exit strategy. It'll be more forced than planned. Ultimately, that's the one thing that I see more with premium financing than not, is that the exit path is a forced exit path versus a planned exit path. And that being said, the next thing that is so important is creating a very clear collateral picture for the client on a very conservative basis, not just a high watermark, but rather like a realistic watermark of like, this is what you're going to need for collateral year over year over year as the loan accrues, as the policy performs. So that way the client knows, okay, I do have that collateral, or I need to get that collateral. Because if there is a collateral call and that client has to liquidate assets to pay off that collateral, that's going to be a big red flag, and that policy is going to be in trouble, or there's going to be something that's going to need to change. The other thing is we all know rates move. I mean, especially with premium financing, there are different rate lock periods, and understanding those rate lock periods and what could happen, like will it balloon? What will the rates be? The renewal rates? Will it go down? I mean, we've been in a higher interest rate environment, so premium financing has been tougher to design. It is able to be designed, but you have to understand what could happen when rates go up, or when they go down, or when they stay the same. And ultimately, how does that affect the exit strategy, the policy performance, what collateral is needed? So yeah, this is a big topic that's going around a lot these days. And, talking about like premium financing and who should not use it, I'll just jump ahead there, Eric. If the clear disqualifiers for us of a client who should not use premium financing is if they need the illustration to perform perfectly for it to hit. Meaning, like you have to have AG 49 all years, every year until year 18 for you to exit the loan and use the cash value to pay the loan off. Another one is if a client has very low liquidity or a concentrated risk in a particular portfolio. Like, for example, they're very heavy in real estate and no cash. That's a problem. If a client is emotionally uncomfortable with volatility, like, they have a very low risk tolerance, then I would stay away from premium financing. Or if they're treating it as like a return play, like, oh, I want a return on my money, I would say stay away from premium financing. And the other thing is, and I see this a lot, is the clients are not explained how to unwind and pay off the loan.
Now it looks like we've lost Seth as well. So
no, I just had to sneeze. I didn't want to sneeze on camera. Sorry.
Well, it's actually a perfect transition. When we talk about premium financing, and it doesn't have to be premium financing, but a lot of the firms that we work with, it's not your typical middle America individual that's purchasing a policy. A lot of these people, it's sophisticated buyers, and sometimes we position a sophisticated buyer versus everyone else. So what do you think, what are some of the differences, or how do sophisticated buyers approach buying insurance differently than really everyone else?
Yeah, well, I know sophisticated buyers will understand the different levers that can be pulled, not from a product standpoint, but also on a premium financing standpoint. It's like they get the leverage. They understand, maybe they do have a strong real estate portfolio. They get leveraging. They understand how powerful debt can be. But they don't ask just like, hey, what's the return? What does this protect me from? They understand early on, like, this is a hypothetical situation and not a promise. They know that control and options matter more than optimization. So they get like, well, what can I do inside this policy? What are the different index buckets available? What are the management styles of those, index managers or the sub account managers? Like, oh, okay, I know that fund family. I like that fund family. And they also understand that cheap today could really mean expensive later. And they're clearly very confident and not performance bragging what their policy could do. They know that they're confident. It's like, hey, even if it underperforms, I know that this is going to be a great asset in my portfolio. And I would say that they optimize for the minimization of regret and not a spreadsheet victory. Like, they're not looking at the numbers and saying, okay, well, that looks really great on paper. They're looking at it as like, okay, well, this is an asset. We know this is going to take time to accrue and do what it's supposed to do. I get it's going to be up and down. I know that there's stress testing that will take place. I know that this could, mean I may have to pay premium later, and that's okay with me. Like, that's where a sophisticated buyer approaches insurance just slightly different. But that being said, I would say everybody should have those expectations. Life insurance, when it's designed properly, again, and optimized for their current situation, is a long-term solution. It is not a short-term solution. You don't buy life insurance because you're looking for a quick cash, win in a year or 2 or 3 years. We can definitely design a policy to look really great in a year, 2 or 3 years, but understanding that life insurance is a long-term asset will only help create expectations that will underpromise and over-deliver. That's just the name of the game, really. So yeah. I would say that's kind of different. And with that, I don't know, Eric, anything else you want to add? I know we only have 3 minutes left, but
no, look, there's a couple of topics left. I know John wanted to cover consequences and opportunity. Ultimately, we'll ask the one question and kind of wrap it at that. But in your opinion, what's really at stake if the design is done wrong, or if all of this is just done wrong? What's really at stake?
Yeah, a lot of money for the client, potentially money for the client. And it could be insurability risk, right? Like if a policy fails and it lapses, and the client needs that policy to be enforced, for at the time they need it the most, their insurability could be in question. But ultimately, it isn't a matter of getting it right. It's getting it optimized initially correctly. And if it's optimized, and again, the advisor is by your side, reviews it on a regular basis, is invested in your goals, your wants, and your needs for the future, then I think it will be the most efficient policy will be designed, especially when we get the information correctly and not just, hey guys, run me this product and this carrier for $1 million. Like, this is my client. I'm very interested in what they are looking to accomplish. Search the market and create the most optimized design strategy possible for them. And I think, that's where, buyers should really have their ears and eyes perked up so that they get what they need.
Well, Seth, I know this is, I'll speak for myself, but this has been fun. I wish John was able to stay on. Maybe, we'll spin back and catch up with him, but hopefully everybody's appreciated the last hour or so. I know we shared a ton of good information and a ton of good things. So I think we'll go ahead and just end it here.
Absolutely. It's been a pleasure.
Thanks,
everybody.